On the front of an auto insurance card, 3 numbers sit in a row: 25, 50, 25. Most drivers have never been told what they mean. Fewer still have been told what they leave behind. They are not the price of the policy. They are not the value of the car. They are 3 maximums for 1 injured person, for everyone injured in 1 crash, and for damaged property. Picture a driver who meets their state's legal minimum and assumes that word. Minimum means enough. One afternoon, they cause a serious crash. The medical bills, the wages lost, the damaged vehicles, they climb past those 3 numbers within hours. The insurer pays up to the limit written on the card and not $1 more. Everything above it does not disappear. It becomes a personal obligation that can follow a paycheck and a bank account for years. In the next few minutes, we will take those numbers apart, run them through 2 fictional crashes, and show where a legal, fully paid up policy can still leave a gap. Hey, welcome back to Policy Unpacked. If you're new here, this is where we read the fine print so you don't have to, in plain English, with no sales pitch. Glad you're here. Today, it's those 3 little numbers on your auto insurance card, and why the word minimum might be the most expensive word on it. Quick ground rules first, then we dive in. This is general United States education, not personal advice. Every crash, driver, and cost here is illustrative, and real limits, exclusions, and state rules vary. We are using the common split limit format. Some policies instead use a combined single limit. Your declarations page controls. Most insurance in this season protects something of yours, your income, your home, your life. Auto liability is different. It protects other people from you. The Insurance Information Institute frames it plainly. Liability pays for what you owe to others when you are at fault. Bodily injury liability covers medical expenses, lost wages, pain and suffering, and legal defense for injuries you cause to other people. Property damage. Liability reimburses others for the vehicles and property you damage. Notice the word missing from both. Yourself. Liability does not repair your own car or treat your own injuries. That job belongs to 2 separate coverages we will name later. Liability exists for the person in the other vehicle, the pedestrian, the family whose fence you drove through it. Why does the law care so much about that stranger? Because a car can cause hundreds of thousands of dollars in harm to a person who never agreed to take that risk with you. Nearly every U.S. state requires you to carry auto liability insurance before you can drive. There is one notable exception. New Hampshire does not require a policy. Instead, it requires proof of financial ability to cover the harm you might cause. The principle is the same everywhere. If you injure someone, there must be money behind you. So the state sets a minimum amount of that money. And almost everyone makes the same assumption that the state, having thought carefully about accidents, set the minimum at a level that would actually cover one. That assumption is where this episode lives. Keep those 3 numbers on the screen. By the end, you will watch each one get spent, and you will see exactly what waits on the other side. The format has a name. Split limits. 3 numbers, written with slashes, in a fixed order. Bodily injury per person, bodily injury per accident, property damage per accident. Take the common example, 25, 50, 25. In dollars, 25,000, 50,000, 25,000. Most people read that as $75,000 of protection and stop there. That reading is wrong in a way that matters. The first number is the maximum the insurer will pay for bodily injury to any one person you hurt. $25,000 for that individual, not per year, not per claim you feel is fair. Full stop. The second number is the maximum for all bodily injuries in a single accident, combined. $50,000, the ceiling over everyone in the other vehicles put together. Watch how those 2 numbers interact, because this is the first trap. Injure 3 people in 1 crash. The per accident ceiling is $50,000. Split evenly, that is roughly $16,000 each, even though the per person limit is $25,000. The per-person number was never a promise that everyone gets $25,000. It is a cap on any single person, sitting underneath a smaller shared ceiling. As the Institute notes, multiple injured parties can exhaust the per-accident limit quickly. The third number is property damage, per accident. $25,000 for every vehicle and object you damaged, combined. One modern SUV can approach that figure by itself. Add a second damaged car, a guardrail, a storefront, and the third number is gone before the injuries are even counted. So the honest way to read 25, 50, 25 is not $75,000 of protection. It is 3 separate walls, each with its own height, each able to be breached independently while the others still stand. What happens when the harm you cause is larger than the wall? The Institute is direct about this. A single serious accident with multiple victims can exceed the policy limits, leaving both sides exposed, the injured parties and the policyholder. Exposed is a soft word for a hard event. If a covered judgment exceeds the available policy limit, the policyholder can be personally responsible for the difference. What a claimant can collect and which income or assets are protected depends on state law and the facts of the case. This is the boundary reveal of the whole episode, and it arrives early on purpose. The 3 numbers do not describe how much protection you have, they describe how much you have before the loss becomes personal. Before we test them against a real crash, one more piece of anatomy, because people confuse it constantly. Liability is only 1/3 of a typical auto policy. Liability covers the damage you cause to others. Collision covers your own car when it hits an object or flips over, subject to a deductible. Comprehensive covers your own car from non-collision events, theft, vandalism, fire, flood, hail, and animal strike, and generally costs significantly less than collision. Keep the wall separate in your mind. When we say the state minimum is dangerously low, we mean only liability, the money that stands between you and the harm you owe other people. Your own car is a different conversation with a different deductible. The 3 numbers are now defined. Watch what an ordinary Tuesday afternoon does to them. Meet Daniel. He and every dollar in this example are fictional. The numbers are not a quote or prediction, they are a stress test showing how split limits operate. Daniel carries 25, 50, 25, and has never filed a claim. On a wet afternoon, he looks down for 2 seconds and rear-ends the car ahead. No fatalities. One other driver, moderately injured. This is not a catastrophe. It is the kind of crash that happens thousands of times a day. For this illustration, suppose the other vehicle costs $12,000 to repair. Medical treatment and lost wages total $40,000. The total claim is $52,000. Not a catastrophe. Still enough to test 2 of Daniel's 3 walls. Send that through Daniel's 3 walls. Property damage, the other car's repair fits under his $25,000 property wall, so that wall holds. Good. Then the injury. The illustrative loss is $40,000. Daniel's per-person injury wall is $25,000. Subject to the claim and policy, the most available under that wall is $25,000. That leaves a $15,000 uninsured gap in the illustration. Whether it becomes an amount Daniel actually pays depends on liability, settlement, judgment, collectability, and state law. The essential point is simpler. The policy contains no additional bodily injury limit for that person. And notice who is also hurt here. The injured driver has real bills and a legal right to be made whole, but Daniel's policy ran out. So that person is now chasing Daniel personally for money he may not have. The low limit did not just fail Daniel, it failed the very person the coverage exists to protect. This is the first reveal, and it is deliberately undramatic. A moderate crash, no death, no courtroom, no worst case. An illegal, fully paid up, state-approved policy still left the household exposed to tens of thousands of dollars. One moderate crash illustration. The property wall held. The injury wall left a $15,000 gap. The word minimum described compliance, not the size of the possible loss. Before we make it worse, hold one fact in view. Daniel's own car, his own hospital visit if he had one, None of that is in these numbers. Liability only ever counted what he owed to the other person. His side of the crash is a separate unpaid ledger. Now change one variable. Not Daniel's driving, not his policy, just the severity of the crash. Same Daniel. Same 25, 50, 25. This time, on a faster road, the crash is serious. 2 vehicles heavily damaged, 2 people hospitalized, 1 with injuries that keep them out of work for months. For this second illustration, suppose the cover injury claims total $350,000 and the property claim totals $50,000. These are hypothetical figures chosen to make the policy mechanics visible rather than predict a typical crash. Set the $400,000 total beside Daniel's walls, 25 per injured person, 50 for all bodily injuries, and 25 for property. The property claim exceeds its wall by $25,000. The injury claims exceed the shared bodily injury wall by $300,000. The size of the loss did not change the limits printed on Daniel's declarations page. If the claims are covered and liability is established, no more than $50,000 is available for bodily injury and $25,000 for property under these limits. The remaining claimed loss has no liability limit behind it in Daniel's auto policy. The injured people take their claim to court. And here we reach the part almost no one is warned about. If the judgment exceeds the policy limit, the insurer pays only up to the limit. The policyholder is personally liable for the difference. If a final covered judgment allocates $400,000 in the same proportions, Daniel's available auto limits total $75,000. The potential uninsured difference is $325,000. Collection rights and protected assets vary by state, but the judgment itself does not shrink to match the insurance. This is the second reveal. The policy limit does not cap what you can owe. It only caps what the insurer will pay. The two are not the same number, and the space between them is your savings, your wages, and potentially your home. $75,000 in available limits. A potential gap above it. The 3 numbers did their job exactly as written. Daniel had assumed they promised more, which raises the obvious question. If the minimum is this exposed, why is it still the minimum in most of the country? The numbers reveal a pattern. State minimums vary widely, and some remained unchanged for decades, even as medical care, wages, and vehicle repair became more expensive. $15,000 of bodily injury per person can be consumed quickly by medical treatment and lost income. The legal floor and the possible size of a serious claim answer different questions. That is the mismatch to remember. The minimum is set by statute, while repair costs, medical costs, and court awards continue to move. This is the point where a less careful channel would name a villain. We will not, because the honest answer is structural, not conspiratorial. Minimum limits are set by state legislatures. Raising them makes the cheapest policies more expensive, which is politically difficult. So many states simply left the number where it was. There is no single culprit. There is inertia meeting inflation. But the floor has started to move in a few places, and the movement tells you how far behind it had fallen. California, effective January 1, 2025, raised its minimum from 15, 35 to 30, 60, 15. The first major increase in decades, doubling the per-person bodily injury requirement, a 100% increase. New Jersey also completed a phased increase to 35, 70, 25 in January 2026. These changes do not certify the new limits as sufficient for every crash. They show that a statutory floor can remain fixed for years and then move sharply. So here is the precise, non-alarmist statement of the problem. A state minimum is a legal threshold. It is the least coverage you may carry and still drive lawfully. It has never been a statement that this amount is enough to cover the harm a driver can cause. Confusing legal with sufficient is the single most expensive misreading on the entire policy. And there is a second way the number can fail you, one that has nothing to do with your own limits. The other driver, the Insurance Research Council, in a 2025 study estimated that in 2023, 15.4% of motorists were uninsured. More than 1 in 7 drivers. If one of them causes your injuries, their liability coverage is not merely low, it does not exist. 2 further coverages address that. Uninsured motorist coverage reimburses you for a crash caused by an uninsured driver or a hit and run. Underinsured motorist coverage handles the shortfall when the at-fault driver's limit is too low to cover your full damages. For instance, if they carry that 15,000 floor and your injuries cost far more. Whether you have this protection depends heavily on your state. According to the Institute and the NAIC, 20 states plus the District of Columbia mandate uninsured or underinsured coverage. Most other states require insurers to offer it, but let drivers decline, and only a handful require underinsured coverage specifically. In a state that lets you decline, you may have waived, with a single signature, the exact protection that covers the 1 in 7 driver with nothing. This is the third reveal, and it flips the episode around. Your 3 numbers protect other people from you. Uninsured and underinsured coverage is the part of the same policy that protects you from everyone else's 3 numbers, including the drivers who have none. So the picture now has depth. The first wall is your liability limit, the second is uninsured and underinsured coverage against the other driver's limit. Is there a third wall for the gap the first one leaves? There is. It is called an umbrella policy, and it exists precisely for the scenario we built with Daniel. An umbrella policy provides additional liability protection above the limits of your auto and homeowner's insurance. The mechanism, described by the Institute, is simple to picture. The umbrella sits above your standard policies. Once the standard limit is exhausted, the umbrella covers the remainder, up to its own limit. Return to Daniel one last time with a different setup. Suppose he carried $100,000 of auto liability plus a $1 million umbrella. Now, a $400,000 judgment arrives. In this simplified example, if the loss is covered by both policies, the auto policy could pay its $100,000 and the umbrella could pay the next $300,000, subject to their terms and limits. Without the umbrella, the same illustration leaves $300,000 above the auto limit. The extra policy changes the amount of insurance available, the contracts, exclusions, and judgment determine the actual result. This is not a pitch to buy an umbrella. It is an explanation of what one is and where it sits. Whether it fits any household depends on assets, budget, the underlying limits it requires you to carry first, and rules that vary, exactly the kind of decision that belongs to the person and, where needed, a licensed professional, not to a video. But the structure is now complete, and it is worth saying in one line. Liability limits decide how much the insurer pays before the loss becomes yours. Uninsured and underinsured coverage decides what happens when the other driver's limits fail. An umbrella decides whether there is a ceiling above your ceiling. 3 layers. Most drivers were only ever told about part of the first. You do not need to become an underwriter to read your own exposure. You need 6 questions asked against your actual declarations page. The summary the insurer sends that lists your coverages and limits. Question 1. What are my 3 numbers, and am I reading them correctly? Per person, per accident for all injuries, per accident for property. Say each one out loud with the word "it" caps. Most misreadings die here. Question 2. Is my first number, per person, a floor or a ceiling? It is a ceiling. Compare it honestly against the serious injury cost ranges, $100,000 and up. If your limit is a fraction of that, you have located your gap. Question 3. Is that the least my state allows, or the amount I chose? Find your state's current minimum. If your limit equals it, you are carrying the legal floor, not a level anyone certified as sufficient. Question 4. What protects me from the uninsured and underinsured? Look for UM and UIM on the declarations page. If you live in a state that lets you decline, check whether a past version of you already did. More than 1 in 7 drivers carries nothing. Question 5. What sits above my limit? Ask whether you have or could qualify for an umbrella and what underlying limits it would require. This is the difference between a hard ceiling and a second, higher one. Question 6. What is not on this list at all? Liability, uninsured and underinsured concern, other people and their fault. Your own car and your own injuries live under collision, comprehensive, and your health coverage. Know which ledger each risk falls on before you assume it is covered. Pause here, open your declarations page, and answer the 6 questions in order. If question 2 exposes a large gap, or question 4 comes back blank in a state that let you decline, those are the exact items to raise with your insurer or a licensed professional. Return to the 3 numbers from the beginning, 25, 50, 25. They were never the price of the policy, and they were never the strength of your protection. They are the point at which the insurer's responsibility ends and yours begins. A ceiling, a shared ceiling, and a property ceiling, each one able to be spent independently, each one shorter than a single serious crash. The right question was, never, am I legal? It was, what happens the moment the harm I cause is larger than the number on my card? Here's the mental model to keep. A state minimum is a legal floor, not a promise that every loss will fit beneath it. A judgment does not automatically shrink to your limit. The policy only supplies the coverage it promises. And the broader protection may have 3 layers. Your liability limit, optional or required protection against other drivers' limits, and any umbrella above your own. None of that tells you which limits to buy. It cannot, and it should not. The right number for any household depends on assets to protect, budget, state rules, and other coverage. Decisions for that household and a licensed professional made against the actual policy, not a video's illustration. Your declarations page and your state's law control your result. Read the actual coverages and use appropriately licensed help before changing a policy or acting on a claim. Next time, the risk moves indoors. The landlord insures the building. Who protects everything you brought into it? And the liability that follows you through the door? Subscribe, and we will unpack renter's insurance next.